view of the budget, the advent of what? The advent of change. And what we've seen is some more tax creep coming in from this government. So this is our specific commentary on it, where this week we're looking at the negative tax changes for expats, whereas next week we'll look at the positive changes for expats and what you can do. And so this is what we want to do now. Now, the British government it's a tax and spend government. So what we see now over two budgets, the Halloween budget of 24 and the Advent budget of 25, we've seen the advent of 70 billion pounds worth of tax increases from the UK. Somebody's got to pay that, and it could be you. So let's have a look at who has been majorly impacted in this did and how that affects expats living in the UK, expats living outside the UK, or if you want to change your status and review your portfolio and change your individual status to be an expat living and working abroad. Having in mind that um, there are some changes you can make to holding assets that don't necessarily need you to move. We've seen some big changes in this budget, which actually you can do some tax planning around it without you individually necessarily changing your individual tax status. You'll find out more at our website, privatepartnership.com. If you contact us, we have a free review to all new clients online, a full consultant review, and if we can help you, then we can work together to find ways of holding assets uh, uh, abroad for your family, your business, whether you're living and working abroad or not. So let's get into it and look a bit more at the Advent budget, where we the negative tax changes for expats in this Advent budget, and it was all about a tax on your capital assets. So anybody that has earned income during their lifetime and saved income during their lifetime, uh, a paid income tax, a paid national insurance, knowing that they might pay inheritance tax when they die, those assets that they're built up, be they in property, uh, investment portfolios, or pensions, and now having their tax being taxed more and more and more, both as the income from those investments and the capital that they can receive from them. So let's have a look at, first of all, the first big way that's negatively going to affect expats. And sorry, before I clarify that, an expat living outside the UK has got a negative impact if they've got any sort of income in the UK. So if they've got a public service pension, or they've got rental income, or they've got capital gains, or other fixed income from the UK, that's going to be affected by personal allowances. Confirmed in the Advent budget that the change that's going to come in personal allowance is nothing. Not only is it staying frozen as under the previous tax regime from the previous government, it's going to be extended by another 3 years. Why does the government do that? Why do they freeze the tax thresholds? Because it'll move more people as inflation occurs, as prices rise, as incomes rise, it moves more people into a higher rate of tax. So, whereas maybe 10 years ago, 15 years ago, a pensioner, state pension was half the personal allowance. Now it's almost exactly the same as a personal allowance. So everybody creeps into a higher and higher tax band. Um, with the freeze since 2022, it's already doubled the number of 40% taxpayers, and that's only set to increase and double again by 2031. So as you reach the ceiling, 50 or 100,000 to go into higher rate tax bands, now the next pay rise, the next increase, the next promotion, the next success is going to take you into an even higher tax rate. What good does that do the government? Well, it means that they can project forward to the financial markets that they're going to get more tax from you in the future. Therefore, when they borrow money from those financial markets, they could do it at a better, cheaper, lower rate, irrespective of the fact they're already borrowing at historic high levels. Historic high levels, never been seen before, even post World War II, never been seen before. That money is going to be paid back with interest to the government gilt markets, and that can only be paid back from taxes that are raised from people. So we're getting more and more into a situation where more borrowing, more interest, more spending, and more tax is needed. And so now taxes have been expanded onto the assets that you have got, and the frozen bands will take more and more income taxes, capital taxes, dividend taxes, and savings taxes into a higher rate band. And we've also seen another big impact, and it's a new thing, and again, it's a seed of a potential um, a creep of tax in the coming years, is a distinction and surcharge taxes being introduced on specific types of income. So, depending on how you look at it, how I see it is that the plan from the Treasury, from the budget, for the budget was to increase income tax by 2%. But politically, they decided they couldn't do that because that was their manifesto commitment, not to increase income tax on working people earning below £45,000. What in fact they've done then is they've increased the income tax rate by 2% by calling it a surcharge, and they put it on everything apart from what you earn. So if you've got a 45,000 salary and you've got a property rental income as well, that property rental income will pay an extra 2%, whether you're a basic rate taxpayer or high rate taxpayer, be an extra 2%. So instead of paying 20, 40, 45, your property rental income is going to become 22, 42, and 47. So those higher rates are going to apply going forward, not just for property rental income, but also for dividend income. It's an extra 2% on that. Now, dividends are already uh, taxed at a slightly different rate, so the basic rate is a bit lower. So you've got this rounding it off. It's eight and three quarters, 33 and 39%. So they were all going up by 2% as well. And the savings taxes rate, you get an extra 2% surcharge on that. So if you've got any cash savings, any investments in shares and companies, whether it's a portfolio investment or a company that you built up, any dividends you're paying, you're going to be paying more tax on that. In addition to just paying the same rates on income tax. So it's an income tax rise in all but name, due to come in on your investment assets in April 27. Now, why the Advent budget in December 25 not introducing the higher rate tax until April 27? It's because it's a new type of tax. So it's a surcharge on an existing tax. So to calculate it and to get it to work in the government system, they can't physically make that change before April 26 and the start of the 26-27 tax year. But by announcing it now, they get the credit in the markets that are going to be raising this additional revenue. That goes into projected forecasts, and therefore they can borrow money at a lower level. However, the other thing that it does, it also gives them the scope for this government to have a major implosion, have a traditional March spring budget, and potentially follow through to introduce this 2% income tax rise, with the new Prime Minister, new Chancellor saying they were left a mess by the previous Chancellor and the previous party and everybody else in the world apart from themselves, when actually all they want to do is raise tax and spend more. So April 27 is when the first additional taxes for the property rental income surcharge come in. So that's the tax you're going to pay on income between April 27 and April 28. So you've got a year to consider what changes and what adjustments you might make. Look at it in a bit more detail. Mortgage interest relief on residential property investment for an individual is already limited to a basic rate tax, i.e. 20%. So an individual with a mortgage who rents a property out can only get mortgage interest relief at the basic rate. So if you're a high rate taxpayer, it's a negative consequence. The good news is that the Treasury has confirmed since the budget that the mortgage interest relief for individual property residential landlords will still be allowed at this new rate. So although they call it a surcharge to apply 2% to property rental income, they're going to treat it as if it's an income tax rate in terms of giving you full allowance against the mortgage interest. So you've got a mortgage interest of £100,000, you'll get 22,000 mortgage interest relief. There's a question that could come up within that as well, and depending upon your portfolio, um, would you incorporate your portfolio of residential property? Now, it's always been quite a tricky question, and there's always been a comparative analysis. If you're a residential landlord and you're earning relatively low income on that, but into the basic rate, what the situation is going to be from April 27 is that yes, you can pay tax up to 47%, the highest rate, um, but if you're below 50,000, the maximum tax rate you're going to pay is 22%. You'll get 22% mortgage interest relief, so pro rata, and then your income tax is taxed once as personal income. So it stays pretty much the same, but they've got this 2% increase. What, how would that affect if you went corporate? Now, in theory, if you look at it on the basis of it, transferring your residential property portfolio into a corporate tax route in the UK looks like a good plan because you can get 25% corporation tax maximum. You can even get lower than that. So if your turnover is below 50,000 on your property rental income, you're still only going to be paying 19% corporation tax. Um, and if you've got a big mortgage, it's fully offset as a business expense. So as when you mortgage it individually, you've got your 22% maximum relief to offset against your interest expense. But with a corporate mortgage, you've got a big mortgage finance, then it is offsettable in full as a business expense. But to get the money out of a corporate residential property portfolio now, um, in the UK, you've got the corporation tax of 25% plus the dividend tax. So the dividend tax now has gone up by 2%. So although you're paying 25% corporation tax, on top of that, you've got at least 10 and three quarters dividend tax, but then it goes up to 35 or 41. So you could be paying as much as 66% tax on your residential property portfolio unless you retain the profits within the company. Which is possible. You could retain the profits and pay down the mortgage debt to create a potential gain later on, but that's an option. So they can both work. It depends upon the balance of capital, mortgage, and interest that you've got. But what you need to consider is the cost of going corporate. If you transfer a personal residential portfolio into a corporate portfolio, you've got capital gains tax to pay first of all, and stamp duty because the company is the buyer, and then you've also got the complication of getting the mortgage approval and rewritten, and maybe a whole new set of new mortgage expenses. for the mortgage to be under the name of the company rather than the individual, even though the beneficial owners of the company will still be the guarantors of that mortgage along with the property. So transferring to a company is very expensive because you've got a selling cost and a buying cost in terms of taxes to potentially not save that much. However, there can still be other advantages to the approach when you consider the bigger picture of capital gains taxes and inheritance taxes. If you want to consider more about um, how you should hold your property rental portfolio as an expat in the UK, contact us at parentpartnership.com. As if that wasn't enough, you've got potentially some more taxes now. It's and this is the mansion tax we're talking about. Again, it's a tax directly on the assets, not whereas the rental is the income that the asset's producing and is treated with a special surcharge. And this new tax is just a tax on the capital. So at the moment, there's already a council tax you're paying, and that's being progressive, being worked upwards depending upon whether you have enough occupancy in your tenancy or whether it's deemed to be an empty property. So those issues are going on. But the councils from April 28 are going to be able to charge and collect on behalf of the national government what's called the mansion tax. So it appears to be a local tax, but in fact it's going straight to the government. Now, again, why is it introduced in April 28 when it's from the Advent budget in 25? The reason being primarily that the legislation includes a provision to get a revaluation of all the assets. So the councils will go through this process with their council tax rateable authorities in the spring of 26 to re-rate all the properties, make sure everybody's got an up-to-date valuation, and those can then be tagged in the upcoming year, 26, 27, for those that will be eligible to pay the additional mansion tax, for which it's just a surcharge of additional tax that's going to the central government. So it starts at over £2 million valuation of the property. This will be set as your rateable value by the council, not your marketable value. But then it goes up in bands. So in at 2.5, it goes up to 3,500 a year. 3.5 million goes to 5 million a year, and over 5 million goes to 7.5 million a year, 7,500 a year on a £5 million property. Now that's cash due payable directly out of a capital asset. So you've got to find a way of cash funding that as a basis. So you can imagine that there's going to be some sort of funding being provided by borrowers and mortgages to have some flexibility in their programs to allow them to pay this additional mansion tax for you if cash flow is an issue on that. So your property portfolio, if it includes properties over 2 million and is generating substantial property rental income, is negatively going to be impacted. And it won't stop there because that's going to affect the capital values of property. UK property has been a really great investment for over 50, 60 years, but that's because of the incentives for people to do that. There's a high level of property ownership in the UK because you get personal private residence capital gains tax relief, saving up to 24%, and you used to get full mortgage relief. Now that's been reduced down, but still you get mortgage interest relief on what you're paying. So those have been drivers of the property market, and now the government are taking those back. And by taxing higher value properties, it will put them at the ceiling. It's almost that you want to take your £2 million mansion and split it into two £1 million luxury apartments and not pay the mansion tax. It is possible to do that. You can't make it up, but for a government that needs to tax and spend, they've created a new type of investment that will come in and affect those property portfolios from April 2028 and before that, because the property markets can be affected straight away. So pricing in the market may well be affected, but there's just not going to be as many buyers because a buyer of a property that's going to be worth 2.5 million now has to consider the mansion tax in addition to everything else. So let's consider some of the other impacts and the negativity things that have happened. There was a lot of speculation that national insurance was going to be introduced to property rental income. That hasn't been done. So it just confirmed it's a surcharge at 2%. But that 2% has also been added to dividend and savings tax portfolios. So wherever you've got any capital in a business, in an investment portfolio, in a property rental portfolio, that additional income is being taxed at 2%. Personal allowances are frozen to allow tax creep to progress, but also the inheritance tax as well. So the inheritance tax threshold continues to be frozen at the current rate. So once your estate's worth more than £1 million, if it includes a principal private residence in the UK, and now including your pension fund as well, then it's all subject to inheritance tax of 40%, taxed as income when you earn it, taxed as a capital asset or investment income when you generate unearned income, like in that way, and then it's taxed again when you die or when you sell on capital gains tax. So it's a big change for the property market, and it will affect prices in the short term, and people need to consider what actions they need to take. The unincorporated tax residential property landlords are going to potentially face higher tax rates. If you're an expat and your property rental income is one or two properties and it's not that high, then a couple owning a property or two can still earn the personal allowance on that property rental income without paying tax. So it's definitely going to be people or couples on more than 25,000 a year, or individuals more than 12,500 a year, before you start paying this additional income surcharge. So incorporating to reduce the costs isn't necessarily the right way to go. It can work for some people, but not everybody. Property assets and property income are frozen in the UK, and therefore they're always going to be taxed in the UK. There's not much you can do about that. Have in mind about dividends and savings, though. Now, for expats, we can set up a Cyprus family or business trust. And when you've got a business trust, that can then hold your share portfolio, or it can hold your investments directly in there, and protect them from some of these additional tax increases. So if you are a corporate landlord with a residential property portfolio, there's potential that you could settle those shares into an overseas trust as a way of protecting yourself from some of the excesses of the income that you receive. Dividend income is movable. So if the beneficial owner of that dividend income is an individual that lives abroad or a trust company that is abroad, then the dividend will be paid abroad. So for expats, they could be in Cyprus or other jurisdictions and pay 0% tax on dividends and savings. You can move yourself as an individual to be tax resident to get those tax benefits, or you can move yourself as by creating a family investment portfolio that you can run and administer, and it takes your tax registration for the share portfolio, the investments, and the overseas assets you've got offshore into a zero tax regime, and that's legitimate. Above that, potentially also you're avoiding inheritance tax. If you gift assets away, then potentially after 7 years you've got no inheritance tax left. There could be lifetime inheritance tax liabilities, but if there's not, if the gift is within the family, then potentially there's no inheritance tax when you gift it into a family investment trust. So that's interesting then, isn't it? So you could give up ownership and beneficial ownership of the asset, but still have some influence and control through the family arrangement and not pay tax. Now we're getting into tax planning, not to break the rules, but to um, save tax across border and down generations. So what we want to do is if we can't reduce the capital taxes on your wealth and your assets, then we can reduce the dividend taxes on the income by moving that income into an environment where you're going to pay no income tax, no dividend tax, and no inheritance tax um, uh, across the board and down the generations. So expat tax planning is not just about living and working abroad. It's also about holding your assets in such a way that you're not going to be taxed to pay inheritance tax in the UK. You don't need to own the company to benefit from the income. You don't need to own the property to be able to live in it. You just need to have something which is legal and valid for you to enjoy that and then pass it down the generations as the case may be, and minimise the amount of capital gains tax, inheritance tax, and income taxes you might pay. That's what we do at Product Partnership. So you've got your choice of how you want to do it. For property landlords, they can pay 47% personal taxes to get money out of their portfolio, or you can pay 25% corporate tax, but then you could pay 41% dividend tax on top of that. But there is ways to get your assets held in a lower tax environment. If you want more information on that, contact us at productpartnership.com. Thanks a lot for listening. We'll see you next time.